Hi everybody, welcome to another update on the stock screener. I got a request to look at Valeura Energy. So let's see what has happened. It's up double, so that's a good return. I actually have already looked at it, but let's see what has changed now. So market cap was 620 million. So let's see how the balance sheet has changed. So current assets 293 million. Two, yeah, that's up. So more cash and liabilities 400, 400, let's say 420. Okay, 420. Yeah, that's lower. So they actually made money. That's good. They increased their balance sheet. So currently we are exactly at 500 million enterprise value. Okay, let's look at production. Actually, just look at the presentation. 2440 oil. Well, that's actually lower than expected. 2440 was 22 and is 2440. Not a big change. 2440. Yeah, not a lot of difference actually. Okay. Realized $85 in Q4. Okay, 85 in Q4. I think it should be 85 in Q4. Let's look at Brent. 85 in Q4. Yeah, it's about the Brent price, so now it's 90. So we could use 90 indeed. So actually it should be fair value, 5 times free cash flow. So it's now fair value. Let's look at the debt. No debt. They say no debt. Yeah, they don't have any debt, yes, but they still have 130 million decommissioning obligations. That needs to be taken into account. Because who is going to clean it up at the end? So 7.5 production, Yeah, here it was 8 million, so now it's 7.5. Okay. When I look at this, the reserves are only until 28, 30. That's 5 years, and this one has 8 years. How much will I give this? Yeah, I can give it to 2035, but it's a bit less than 2035. But I will give it to 2035. So OPEX 29.4. It was 23. Is that up? Looks like it's up. $29, $28. I got 23. So what is going on? I want to check 2022. Well, I think production has actually gone up, right? I mean, the cost has gone up. OPEX is 29.4. So it was 23 and it's now 29.4. So I'm just going to use 29.4. CapEx 30 million per quarter. So that's 120. It's going to be 150. I'm going to use 150. Oh, it was 180, so it's down a bit. It's still definitely a lot of capex, higher costs. The interests should be much lower because they don't have any debt. Finance cost 34 million. Well, I don't think they have any debt, so how can they have interest payments? But okay. Let's just use this here, 34 million. Just for the sake of it, it's lower. Of course, this is going to be even lower next year, but let's use these numbers. Yeah, it's probably going to be around 15 then. But who knows? What do we need still? Revenue 85, yes, 90. So today it's 90. CapEx plus SG&A. Okay, what's the SG&A? SG&A plus SRB. SRB is 15 and 25. So the SRB is 15 and the GNA is 25. So this is was 47, 15 and 25. It's a bit down. CapEx is down. Costs are up. Interest is down. Royalty probably the same. Production is down. Okay, so this is the situation then. Using these numbers. Okay, at $90, there is some upside. There is some upside, about 20-30% upside at 90 oil. So here we can just enterprise value. I will just it is this. Revenue is indeed this. Cost is this. CapEx is CapEx plus SG&A. So this was 150. This was the 15. And this was the 25. So that's about 190. Interest was 34. This will probably go down to 0. Net income. I would add a line here for depreciation. Of 128 million. Which will deduct taxes. So this gives a bit of more upside. Looks good. Looks good. How many shares? 102. And 103. Basically the same. So what do we have here? EV to free cash flow of 6 to 4, which is fair value to me, but it does have good mine life extension possible. So a little bit undervalued, but yeah, it's not like it's super cheap, just a little bit cheap, depending on, of course, the oil price. If oil goes back to 70, then this is not cheap. Let's take a look at some more data. I think we're done here. Currently on plant producing 23,000. So they think that they can go to 23,000. Okay, that's 8.4 million. I could say 8.4 if they do think that they can get there. Then it will be like this. Yep, 21, 22, 23. We will see. 23. OPEX a little bit higher. CAPEX, okay. Okay, that's it. Now let's put this company onto our chart. So how are we going to do this? I have this chart here between 70 and 100 oil, WTI. Currently 90, and currently WTI is 85.6. So is this divided by 85.6 times 70? And here we use this times 100. Then enterprise value is this. Production is this. USD is this. And we got EV to NPV 10 is this divided by this. So this is our NPV using all of these things here is about 1010 NPV. That's this number. And if we use 70 WTI, we have an NPV of 480. So half the NPV. EV to NPV 10 is this divided by this. So then it's a bit overvalued. And then we have the last table. The last table, EV to NPV 10 is this divided by this. Now, actually, this should be 2024, but anyway, it's almost the same. So here we have undervaluation at 100 oil. Okay, now we can input this data into here. So what I'm going to do is replace Aurora resources by Valeura energy. And put in the number. You think this is easy? This is not easy. Enterprise value is this. Then we have the upside, only the market cap first. Which is this. And then we have the upside in Valeura Energy. So I'm excited to see what the result will be. Is this a good company or not? And the result is it's pretty good. Valeura Energy is on par with Geopark. At current 85 oil, it has 100% upside and has actually no downsides until 70 oil. If oil goes up, we have 200% upside. So it's really good, but Petrotal is still better. Why is it so good? Because it does still have a little bit of liabilities. So, but I think it's because of the production. The production is good, so it has leverage, and it's just cheap. High depreciation. So depreciation is not a cash item, so lots of cash flow coming in. But of course, a lot of capex and SG&A. But that's not a problem. There is a good amount of cash flow and production growth. 10% production growth for next year, so PE of around 4, which is good. Yeah, PE of less than 4. Some debt repayment still, and then yeah, there is a lot of net back, so 90 compared to 23, so good margin. Due to the good margin, we have less downside. Only at 70 we have downside. And if you compare to these other companies, they all have more downside at 70 oil. So yeah, this is very good, a very good company. Just make sure that we don't go below 70 and you'll be fine. Yeah. Now about that reserve life. Maybe this could be a problem. It doesn't have that reserve life yet, so they need to extend it. Let's say this production gets cut off. What happens to our curve? It drops. So that's the risk. If they don't find the resources and the production, then this could drop a bit. Less upside. So it's important that they show us that they have the reserve life. Currently, they only go to 28. So what happens if they don't find any new reserves from this year? Then all of this production will be gone in 5 years, right? This one has more reserve life, but the production is not that high. It's only less than 1/4. So watch the reserve life. Can they extend this? I should probably delete some of this. Yeah, I should probably delete some of this. And the capex, of course. Yeah, because 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, that's a lot. Maybe too much. 12 years, okay. Let's go for this. Still not bad. Still not bad. No, I'm fine with this valuation. There is upside. Probably 50% upside. Okay. So where does this company go to? I guess around $7. That's my fair value, and I'll see you in the next video. Bye.